Everything that we really see on the market is revolving around the US dollar. So USDC, which stands for USD coin, which is the company that backs it, is a fully collateralized asset, right? $1 in one coin minted. This has become a very prominent sector within our industry. It has grown massively, and it has also led to more experimental attempts in can we create a stable asset algorithmically, aka using a computer algorithm to rebalance the equilibrium, right? To find something that is smooth without having to back it with tons of government-backed fiat that could essentially be deemed irrelevant or removed from you or taken. Hello, everybody. Welcome to another episode of Inner Circle with your co-host, Graham Friedman.
Brian Mint.
It's a pleasure to be here. We wanted to bring you an update episode on recent events that have been occurring here in the crypto industry. As I'm sure everybody is aware, there has been a downward movement in the prices. What we would generally consider to be a winter approaching, and all of this really rallied around or was wrapped around a black swan event with the US Terra coin, what was presumed to be a stablecoin, maybe not so much so at this current point in time. That being said, we wanted to take you through basically what happened and what impact that we believe it will have on this ecosystem and how we see moving forward. So basically, Brian, how do you feel about everything? Are you ready to kick this off?
Yeah, definitely. So, as Graham mentioned, this is one of the less fun episodes that we do, but also one of the, parts of just being in Web3 and crypto these days. So we definitely want to open up by saying, if you are in a position where you feel like you've lost a lot of investment, we feel you. Graham and I have both been through crypto winters and bear markets in the past, but keep your head up. There's many more opportunities to come, and if you want someone to talk to, or you want to just do more research and stay more educated, we are here for you guys as a resource. And with that, let's kind of get into some of these topics here, Graham. Maybe do you want to start with some of the macro stuff that's happening these days? I feel like that's probably a big overarching theme that will then trickle down into our topics that we're going to cover into.
Yeah, absolutely. It's really hard to preface this specific downturn without looking at what's going on at large. Obviously, we have conflicts around the world, some of them being more significant than others, as well as the monetary elements that are happening at the same time, right? We're seeing massive inflation, uncertainty really all around the world, and the traditional equities are selling off. So, one thing that Brian and I constantly look for in the world and in these markets is some way to compare the crypto asset world versus the real asset world, if you will, or the traditional. Are those correlated in any way? Is there anything that we can extrapolate from what's going on? I think in this instance, it's fair to say, right, Brian, that we're looking at something pretty in line with the global macro.
Yeah, definitely, Graham. I would say, a lot of times we like to believe that crypto could be a hedge against traditional markets, but clearly, that is not the case these days. The world has gone through, a pandemic. The world has currently still going through war, supply chain shortages, and most recently, the U.S. monetary policy is going through some changes with the Federal Reserve increasing interest rates. So a lot of these activities that are occurring are creating, pretty negative market conditions, and crypto is definitely involved in that situation. My personal perspective, and I'd love to hear yours as well, is that I think that there's a lot of investors that have gone into crypto that are also investors in traditional markets. So they're applying the same tactics when the market goes down in traditional markets, such as public equities and private equities. They're applying those same buying and selling tactics to crypto, which is causing the crypto markets to trend similarly to traditional markets today. But that's just kind of how I see it. Graham, if there's anything else you'd like to add, I think your perspective would be super interesting as well.
I think you really summed it up quite nicely. To me, all of this does segue us into the pursuit of stability and decent returns, right? Everybody is looking for where can I go to find some sort of safe haven. This takes us to the digital asset space, where there is an entire class of assets known as stable coins. Traditionally, used for moving into and out of positions. They're extremely important to be able to facilitate trades between two unrelated assets by going into something stable. Everything that we really see on the market is revolving around the US dollar. So USDC, which stands for USD Coin, which is the company that backs it, is a fully collateralized asset, right? $1 in one coin minted. Since then, others have come out. There is USD Tether, USDT, another massive attempt at a collaterally backed asset. Then one of the most prominent in Ethereum has been DAI, which is a DAO format for trying to stabilize and create, again, a stable unit of exchange, right? That's what people have been looking for. So as the risk has altered and as inflation really runs rampant in the traditional sector, one of the big things going on in crypto has been to try to find some yield. Basically, this is generally generated by borrowing and lending. Similar things to what a bank would do. This is how USDC also operates. You can give it to vendors. They might be able to borrow and lend against it and return to you some yield. So all that is to say, this has become a very prominent sector within our industry. It has grown massively, and it has also led to more experimental attempts in can we create a stable asset algorithmically, aka using a computer algorithm to rebalance the equilibrium, right? To find something that is smooth without having to back it with tons of government-backed fiat that could essentially be deemed irrelevant or removed from you or taken. So that really leads us to the core of our episode right now, which is called UST, US Terra, a stablecoin based on an algorithm. And Bryan, if you don't mind, would you take us away and just give us a little overview of what exactly is UST?
Yeah, definitely, Graham. And just to piggyback off of what you were saying, the three tokens that you mentioned, the three stable coins, USDC, USDT, and DAI, are most prominent ones out there. UST is definitely in the same ranks in terms of like popularity. It has definitely gained a lot of traction over the past year. The one thing that makes UST different from the three you just mentioned is that it is an algorithmic stablecoin. And what an algorithmic stablecoin is a stablecoin that is pegged to the value of something. And a lot of these cases, it's pegged to the value of USD, $1. And the difference with algorithmic stablecoins is that that peg is maintained strictly through algorithms, strictly through software. And what that implies is that there's actually no collateralization, meaning there's no US dollar to back a UST. Quick tangent here. I do think that these experiments are very interesting, right? Like, imagine a world where you don't have to back a stable coin with something like gold or a physical US dollar or something like that, right? These in a purely digital way that it maintains the peg. This is the experiment that UST is trying to create. The way that they create this actually is by having a two-token ecosystem. So for UST, it lives on something called the Terra blockchain. And the Terra blockchain, of course, has the UST that we've been talking about, but it also has a token called Luna. Luna is essentially a asset that can be minted and burned as needed to maintain the peg of UST. I don't think we need to go into too deep of a detail on how this really works. We'll probably save that for another episode. But just something to think about is that there is a mint and burn for UST, and there's a mint and burn for Luna. And the way that those two assets are minted and burned is determined by an algorithm, which sole purpose is to help maintain a peg of UST to $1. What we're going to explore today, Graham, is kind of how that peg becomes depegged and basically results in the situation we see today. Is there anything you'd like to add to my kind of like high level overview of how UST works?
I think that was very spot on. I very much like your tangent, actually. I think both Bryan and I are in agreement that creating a truly unbacked stable coin, while theoretically seeming impossible at the moment, does have interesting implications in the grander utopian vision of a decentralized world. Ironically, USDT is called Tether because it tethers the digital reality to the current one at present, but there are always hopes that somebody might be able to come up with something purely digital that operates only on servers that can be hosted in a decentralized fashion. So anyway, that's the dream. It does come from a place of, I think, communal interest. There's a lot of pursuits trying to find one of these algorithmic stablecoins. However, a traditional economist might say they are all Ponzi schemes and they are doomed to fail. So it is very much up for interpretation as to how deeply you want to either believe or naysay this idea. That being said, I think it's a good time to get into what exactly happened here, because the algorithm was attacked and the specific mechanic is what failed. Bryan, I don't know if you want to start with some of it. I happen to have the exact details open in front of me, so I can fill them in, but maybe you could give us an outline of how this whole thing got kicked off.
Yeah. I can give a high level overview of, kind of what went down. And Graham, would love you to fill in with details, since I don't actually have that off the top of my head. But essentially, what happened was the algorithm to maintain the peg of UST was attacked or exploited. It depends on who you ask. And the way that it really happened was large amounts of money can basically be used to shake an economic system, right? So the crypto ecosystem is large, but it's not large in comparison to the world's economic system. So if somebody that has malicious intent, or just profit-driven motive, wants to rebalance and shake up the crypto ecosystem, they can do that with large sums of money. So what we saw over the past few weeks is somebody basically took a lot of Bitcoin, I want to say to the order of 100,000 Bitcoin, and used that to purchase a lot of Terra, UST Terra, that resulted in billions of dollars of this person now owning Terra. What you can now do with this Terra is that you can go into pools, and specifically, this is the Curve pool. So for those of you that don't understand Curve, the TLDR on Curve is that it's a place where people can trade stablecoins. And it has deep liquidity, quotes, deep liquidity for stablecoins. But what this person did with this massive amount of Terra is that they basically sold a bunch of Terra into the Curve liquidity pool, which then offsets the peg by a little bit. And from there, it cascades into a few things that we're going to go into next. But I'm going to take a pause there because I think there's a few things that, Graham, maybe you want to dive into in a little bit more detailed level to kind of explain like what happened.
Yeah, absolutely. Bryan, you did a fantastic job. You nailed the numbers correctly. So this was actually extremely well thought out. It was very apparent that they understood the mechanics of the system to the point that they targeted a very small window in time in which it allowed them to cause this attack with a smaller amount of capital. So as Bryan mentioned, it was 100,000 Bitcoin that were purchased, and it ended up turning into 1 billion UST that was in this stash. So what was happening was this Curve pool, which is essentially a basket of assets, stable coins, and the algorithm tries to keep them in alignment via a specific curve that is in the program, hence the name. And they were moving from a smaller pool to what was going to be a much larger pool. So if it had gone from what is called 3 pool to 4 pool, there would be way more capital backing it. This kind of attack would be much more expensive. Even though it would be more expensive, it would still exist, as we see. So there might have been a flaw in the actual idea. However, that being said, they went to the Curve pool. As we were migrating from the smaller one to the larger one, $150 million of that backup, of that collateral, was taken away. Therefore, there was much less liquidity backing the trade and the algorithm, and that's when they started to sell. So what they actually did was you have that 150 million removed from pool 3 in order to put it into pool 4. That takes pool 3 down. At the same moment that it dropped down, they sold $350 million of their UST, or they didn't sell it, they actually pulled it from the pool, making that liquidity drop even farther. That caused the algorithm to drop to about 92 cents, get a little wavery, right? Everyone's looking at it saying, what's going on here? Right as that occurred, they then went to Binance and sold 650 million, the remaining segment of their 1 billion that they had. So you already have that Depeg, and then you have somebody market selling and just driving the price down. That ended up being what was needed to shake the entire industry, to cause enough distrust and uncertainty that you get a cascade of everybody beginning to pull their assets out of this ecosystem. One of the big things that did happen here was they tried to incentivize people to hold this token, this stablecoin, by locking it in something called Anchor. It would pay you yield from some of the trading on the other assets that they did. Everybody started to withdraw their assets from Anchor. Suddenly, liquidity flees the entire ecosystem. And in order to compensate, the algorithm starts to print more of the Luna asset, which is in turn burned to print UST. Actually, I think I have that backwards. I apologize. They make more UST to burn into Luna, ultimately trying to repeg the asset. This caused more Luna to be minted. As Luna began to mint increasingly so, it hyperinflated. And that caused a runaway cascade downwards on the price of Luna. Once Luna got to be too cheap, it couldn't burn itself back into UST to maintain the peg. It became a self-reinforcing loop where both assets began to lose their value. So that's, in a nutshell, what happened. And I guess, Brian, if you want to help us understand what were the ramifications, what was the impact?
Yeah, definitely. And thanks for that very detailed kind of explanation on how that happened. I'm sure some listeners are going to have to rewind that and just kind of piece by piece, like understand some of like those elements that went down, because it was actually quite a sophisticated, coordinated attack. And for those of you that, aren't super familiar with crypto markets, that massive amount of downward sell pressure, really leads to just like a tanking in the price. So it was the downward sell pressure of UST, right? Leads to the value of UST going down. And then as Graham mentioned, there's a hyperinflation of Luna, which leads to that price going down. And as that price goes down, people want to sell Luna because they want to kind of realize at least what little gains that they had, which caused sell pressure on both of these assets, which then led to a spiral.
Degrossing. Both long and short positions count towards gross exposure. In times of uncertainty, market players will withdraw from both long and short positions to cash in what is known as degrossing. This is represented by the extreme selling of all assets across the market in order to quickly establish cash positions.
Something that a personal anecdote of mine is that I didn't realize how important liquidity was when I first got into crypto, having been, exposed to only stocks and kind of like public equities. Like, you just sell at a price and you get that price all the time. But in crypto, it doesn't really happen that much because there's liquidity. That's a very big component of like exchanges and markets. And when you definitely talk about larger amounts of money, like millions and billions of dollars, that type of sell into the market drains the liquidity and therefore like shuts the price down. What Graham has mentioned is that because the prices are going down, people then want to sell because their holdings are getting lower in value. So they want to recoup what gains they even have, causing them to sell, which is then leading to a spiral of price just like dumping precipitously, which is what we're seeing happening to Luna and UST. One thing that I want to bring into consideration here is something called the Luna Foundation Guard. This is something that Luna has created in events such as this to kind of backstop the value of UST to help maintain its peg. What we're seeing, though, is that the amount of money and the amount of value that was lost, which is in the order of tens of billions of dollars, was way more than how much the Luna Foundation Guard could have even backstopped the value for. And this ties back into some of the macro stuff we were just talking about, because the Luna Foundation Guard is actually comprised of multiple cryptocurrencies, some of which was Bitcoin, some of which was Avalanche, and some other tokens. But the problem was that a lot of these tokens were already lowered in value due to macro effects that have been happening the past few months. So the power of the Luna Foundation Guard, the LFG, has already been significantly lowered, so that its ability to backstop the peg has also been lowered. So you can see how macro events are actually correlated and leading to even a worse type of spiral that we're seeing into this UST and Luna exploit. So it's actually quite, all of these events are quite intertangled, and it's very important to understand all the things that are happening, not only in crypto specifically, not this exploit specifically, but in macro events as well, and how those are, trickling down to this like kind of very unfortunate event that we're seeing today. So, Graham, is there anything on the LFG or any other kind of like Luna activities that I may have missed?
Yeah, there's two, I think, very significant elements, which is one, the transparency of crypto. The LFG announced the assets that it was going to stock, as well as its buy timing and its buy pricing. So Bitcoin was one of the most prominent assets there. Therefore, the person, whoever launched this attack, was able to take out shorts against Bitcoin. They knew that by driving this price down, the LFG, Luna Foundation Guard, would have to defend, right? They would have to sell some assets. That put more pressure on the entire market. This is a big conversation now internally in the industry. Do we want projects to build these treasuries? Because then they become a quasi-hostage situation with the industry at large, that, if they get into a position where they have to do a fire sale, that puts the rest of the market at risk. So that was one thing that was very interesting. And we know that based off the on-chain data, this particular investor probably made about 950 million on the Bitcoin short alone. We don't know what other assets they placed bets on. So that's one thing that we can extrapolate. The other thing is, in post-mortem, the Luna Foundation Guard, which is largely governed in a decentralized way, and more realistically, the actual blockchain itself, the Terra blockchain, as they try to figure things out, it's using what is called a DAO, a decentralized autonomous organization, to essentially collect votes from a large enough group to pass in a democratic way. This takes time. It takes 7 days from a vote being approved by the community to actually execute. Therefore, any of their capabilities to halt the chain, right, to stop the downward spiral on the computational side, all had a 7-day buffer, effectively rendering them useless. So that's another problem that people are going to have to look at in the technical construction of these chains, is how can we be lightning fast? Because disaster response really can't rely on these democratic structures that we currently have presently. So those were two very interesting situations. I will say this: Luna itself was beyond the stablecoin element, wanted to become a larger protocol for people to build on. It is what is called an L1, a layer one. It is at the bottom of the application stack. And it did have many people building apps. One of the really good things about it was that they tend to build really nice user interfaces. So things in the Luna ecosystem, when you looked at them, were much more advanced and modern and Web 2 than any of the other apps that are out there, right? So again, you start to get this industry-wide adoption. You're seeing really nice applications. Instead of paying expensive gas fees on Ethereum, because in Ethereum you pay with ETH price goes up. The whole concept here is that you get to pay with a stable coin. So the gas is always a flat, understandable rate. Really attractive. And that, I think, caused a lot of industry players to overlook the fact that this redemption mechanism in the algorithm was very susceptible to something that just recently occurred. And that's one of the reasons that Luna got to be so big. It had tons of rich development mind and energy. Really beautiful interfaces, and it was so easy to interact with. So we are going to ask, what happens to the Luna ecosystem? Do those developers stick around? Do they go to other chains? In my conversations with a lot of projects that are building, they're realizing, we need to have multiple chains that we're going to go on. And again, that really gets us into the multi-chain narrative that I think we've spoken about in the past, and we're really looking at for the future. So that's just some of the summation. Bryan, if there's anything you'd like to add, by all means.
No, that was great. I mean, you kind of hit it on the head. Like, community is something that we talk about all the time on this podcast, and the Luna ecosystem actually had a very strong community. And it's very unfortunate to see, these kind of retail investors that were very excited about what was all the activity that was happening, all the apps that were being built, all the engineers that were even attracted to the space. So, we were really looking forward to see what's next for the Luna ecosystem, or where those developers or builders are going to go, because there was something that was built there. Unfortunately, it was built on a system that was exploited and had some flaws. So, you know, uh, just crypto things, things that happen in this kind of experimental industry that we love to be in and build in and have exposure to. So I think you guys heard me say earlier that a lot of these stable coins, especially the algorithmic stable coins, are experiments. They definitely are. And I think the word experiment can even be expanded to most of crypto in general, which is important to note because a lot of these things are very speculative. They are not fully proven out yet, but I think that's what makes it super, super exciting. So with that, should we talk a little bit about our sentiment on the market these days? I think, this kind of exploit and the attack on Luna has definitely basically made a lot of the symptoms worse on what was already a bear market that we've been on. So Graham, what are your general thoughts on where we're at today?
Yeah, absolutely. I think general consensus would say that we're in a bear, right? We're in what we would call a crypto winter, and that's something Brian and I have been through multiple times. It always comes at you quicker than you might think, but it's generally similar. The asset prices fall significantly. A lot of people in the community like to measure themselves not by where they exited, but by the maximum number that they ever achieved. So it does create a psychological feedback loop. However, our take is we are very big fans of bear markets. We do find that when you go into a bull, things get very frothy. People that don't necessarily have true intentions are trying to just slap a token onto things, thinking that it's a recipe for instant profits. And that really does distract from the industry at large. That makes developer talent more difficult to come by. That makes just general talent outside of the dev world, right? The legal space is extremely essential, as are the biz devs. All of this gets taken away and extrapolated by just increasingly more projects with larger funding. And in the private markets, we started to see the costs of these investments just rise and rise and rise, which is something that I find to be personally disappointing, because if the private prices go up, obviously that really gets impactful on the public markets, because they're going to the public and the general masses at a already steep price, right? We start to see sell pressure. It's not a healthy way to live. So now we've gone through our black swan event. We have this resetting, this repricing, and a lot of it is exasperated by funds, by people that need liquidity. They just want to protect it, so they do what's called regrossing, and they just sell everything. Right? It doesn't matter if there's a loss. We just need to get into some sort of liquid asset. It's been pretty healthy. We've already seen a tiny bounce back today. I think some of the UST drama is starting to be digested and understood, and we're now moving into probably the beginning of what will be a longer winter. So just for a little understanding, the last winter was about 2 to 3 years ish. And for us, Brian and I were working here at Republic during that entire time, just making sure that projects who were building had as much help as we could possibly provide, and laying down the ground floor for really substantial growth and building something that lasts. So in that regard, we kind of like bear markets. Brian, what do you think about the bear market take?
Yep. Totally in agreement. I'm sure you as well as I, we've gotten, calls and messages from our dear friends and people that were maybe concerned for us, and also B, asking what they should be doing. And the answer kind of remains the same, we're in it for the long term. We actually quite like the bear markets because it is a time for building. It's a time to see who's actually very serious about working in the space. And you'll actually probably see this in a few years. But, for Graham and I, the relationships and the builders that we met pre-2019 we have a very different relationship with them than the ones that we met just a year or two ago, because there's this mutual kind of understanding that we survived this a bear market. We were able to have conviction in the technology to build, and there's a long-term vision for what we see this technology can go in terms of democratizing access to financial instruments, maybe disintermediating middle businesses to basically allow for a smoother flow of transactions, and just creating more fair and equitable technological systems to create, to connect creators to the communities and things like that, right? So there is still that promise has not changed. The technology itself has not changed either, but there's still a lot to be built, a lot to be experimented on. So even though we're entering this bear market, like we also know that this is probably not going to be the last bear market of crypto, but we will also be hopeful that we have learned from the mistakes and the exploits that have happened in the past to build back stronger each time. So this is just part of being in Web3 these days. It's still an extremely early and nascent market. So of course, there's going to be a ton of volatility, a lot of speculative investments and things like that, because with high risk, there's also high reward. So if there's a potential of high reward, you get a ton of investors. We are still very excited to be here. We actually just had a conversation with the larger team today. And there's very similar sentiments here. If you are where the builders are, you will still know that there are tons of really smart people working every day to create new technology and build these systems on top of blockchain infrastructure. Whether it's on the Avalanche ecosystem, the Ethereum ecosystem, Polkadot ecosystem, Algorand ecosystem, like all of these layer ones are still pretty healthy in terms of builders. And also in terms of this builder ecosystem, I would also say that private markets, meaning the venture investors and angel investors, are still interested in making moves and plays. But as Graham mentioned, they will be doing this with a lot more of a scrutiny towards valuations, which we think is like just bringing it down to what we consider reasonable. It was very unreasonable in the past. And hopefully now with a more realistic vision on like how projects are valued, a lot of investors are looking forward to being able to deploy capital into companies in more reasonable valuations so that the froth is no longer there. So that's kind of my perspective these days. We're not planning on exiting or leaving anytime soon. We are definitely here to stay, here to support the next generation of builders, as well as the current generation of builders and thinkers and entrepreneurs. So let's do this. Let's build.
Yeah. On that note, Bryan, is this anything like it was in 2019, 2020 in terms of trying to get people to invest?
Oh, great question. So I would say that it is very different, right? Every single time these cycles repeat, there's another layer of maturity that's being built on top of this ecosystem. In 2019, 2020, the majority of the narrative that I was hearing was, should I even invest in tokens? Like, can I get in on the equity of the company, right? That was a big narrative that was happening. And we are not seeing that at all in this round. Like, people still want tokens. They just want it at better valuations. There are investors that care about equity, but even if they care about equity, there's token warrants, token side letters. Like, there's still appetite for this, which to us means that the investor confidence in the technology of tokens is there. It's just now, how do we build more robust ecosystems around token design and these types of new experiments that we're seeing today? So to me, it is quite a different landscape and a different level of confidence from what I saw back in 2019, 2020. What about yourself?
Yeah, 100%. We were knocking on doors back then, right? Trying to raise for our clients, and people said, you still buy tokens? So now, it's very interesting. The capital markets are very full. Many people have raised money recently. I think that's largely in response to all of the inflationary things that have been going on. People are looking for other investments that can outpace. And therefore, there are still plenty of people that will keep this alive, that will keep the builders funded and moving. So that's going to be really exciting. The other major thing that I can see is that previously we didn't have the NFT space as it is right now. It was a very fledgling, very young thing. It did exist. NFTs have been around longer than you think, guys. But now they are a thing and they have their own community. Not only that, the community is fundamentally different than the cryptocurrency community. It is not a libertarian, inclusionist, full transparency kind of thing. It's more about grouping and exclusivity and being cool and having this collective identity, right, that brings people together. So that is extremely healthy. We are seeing lots of IP from older movies, TV shows, video games, you name it, characters from years past that are being revamped, brought back to the digital space. And that is also going to be a very thriving thing. So I'm very excited. I think we're going to see a ton of growth. One piece of very good news is that the ETH merge event that really kicks off Ethereum's scaling solution does look like it's going to happen in the very near future. So it's gone through all of its tests. It's now going to Ethereum's testnet to do it, which is like super cool. That means we're baby steps away in something that we've been waiting for since, well, I was talking about this in 2017. So a long time, but that is phenomenally huge news. And that will usher in another layer of scalability on what is the largest shared computer on the planet. So it's very exciting. Also, I would say in a nutshell, a lot of this lesson reinforces Bitcoin's message, right? Bitcoin was actually made in response to the bank printing. There is a line in Bitcoin's first block, right, about the chancellor bails out the banks. So we're seeing, as we get back into programmatic money, people do chase some of the same things that they chased previously. And it is nice to see something that is just hard, proven, battle-tested. Bitcoin doesn't do too much, but stay there. And I think that's very exciting in its own right. But, we're seeing an entirely new generation come on in. And I'm super excited for what's to come. We do have a lot of clients. I will say that we are advising right now. We're helping them build their companies. We're helping them bring them to market. Bryan, just a really quick recap, like how are we really, facing our clients and what are those conversations looking like?
Definitely. We at Republic Crypto, we are working with crypto builders and founders every day. We have many clients across multiple verticals within crypto, call it NFTs, entertainment, DeFi, layer one, interoperability, zero knowledge. We are seeing, just a lot of building, a lot of energy and passion in the founders that we talk to. It's actually quite inspiring. I'm going to be honest. There are days where I'm just like, wow, the market's pretty rough today. But we talk to our founders and they're just like super stoked about something very specific that they're building. And it kind of renews our interest. So it really is about, just staying close to the people that are passionate about the technology, looking to build a better infrastructure for the future. And the clients that we have, are also inspirations to ourselves to keep building in this world as well. We think that the level of smart, intelligent people that are coming from traditional finance or traditional industries into crypto is shockingly overwhelming. And that, if you follow where smart people are building, I think there's always just something there. So to our clients and to our projects that we work with, like shout out to you guys, we're here to support you all. And you guys also give us a lot of life too. So the feeling is definitely mutual. We believe that there is a long road ahead to build. We're still extremely early in this space, but we would love to just kind of work with the next generation of founders and builders to create the most robust and strongest community that we can to unite all of Web3.
Well said. All right, everybody.
Awesome.
Thank you so much for your time. I hope this was enlightening. Again, we believe that this is future tech no matter what. So in some ways, you could just look at the purchasing power of your dollar has been going up in these markets. That's how I like to phrase it. And we hope that if anybody was affected by this UST Luna event, our heart does go out to you. I know Bryan and I both had a tiny exposure, so we feel your pain. And of course, you just got to keep on. And we believe that the next cycle will bring some really amazing things. So with that, I bid adieu and thank you so much for tuning in.